The SpaceX IPO is poised to become the largest initial public offering in financial history. SpaceX will list its Class A common stock on the NASDAQ Global Select Market under the ticker symbol SPCX on Friday, June 12, 2026. The company has set a fixed offering price of $135 per share and plans to raise approximately $75 billion in gross proceeds. At the $135 per share IPO price, SpaceX will carry an implied market capitalization of approximately $1.77 trillion, making it roughly the 7th largest publicly traded company in the U.S. For investors in passive index funds, the SpaceX IPO also carries implications that extend well beyond the company itself. The way major index providers have responded to this listing affects how and when SpaceX enters the benchmarks that drive trillions of dollars in passive investment capital. NASDAQ, FTSE, Russell, and CRSP have all adopted or maintained fast entry mechanisms that allow SpaceX to enter major indices after as few as 5 to 15 trading days. The most consequential NASDAQ change is a new fast entry provision that allows a newly listed company to enter the NASDAQ 100 after just 15 trading days. Under the new Russell rule, IPOs are eligible for index inclusion after just 5 days of public trading if they have an investable market cap exceeding the Russell Top 500 breakpoint. Since 2017, CRSP market indices have included eligible IPOs on the 5th trading day after listing. None of these indexes require profitability. In contrast, the S&P Dow Jones indices determined that no changes would be made to the eligibility criteria for the S&P 500, the S&P Midcap 400, or the S&P Smallcap 600. For SpaceX specifically, the decision means the company will not be eligible for S&P 500 inclusion until at least June of 2027, and only if it satisfies the profitability requirement at that time. These differences matter. Faster inclusion in the NASDAQ 100, Russell 1000, and CRSP indices improves market representativeness. Index funds aim to provide investors with exposure to the investable equity market, and faster inclusion ensures that index fund investors have exposure to economically significant companies sooner. But there are risks. Index funds tracking the NASDAQ 100, the Russell 1000, and CRSP indices will be required to purchase SpaceX shares regardless of the company's fundamentals, its valuation, or trading history. And with only approximately 4.24% of shares available for public trading at IPO, the mechanical buying pressure from passive funds could amplify price volatility and contribute to an inflated entry price for index fund investors. S&P 500 index fund investors will not be required to purchase SpaceX shares until the company is traded publicly for at least 12 months and demonstrated GAAP profitability. This protects investors from the risks associated with buying into a low-float, newly public stock at potentially inflated prices. But there is a trade-off. If SpaceX stock price appreciates significantly in the months following its IPO, S&P 500 index fund investors will not participate in those gains until the company is added to the index. The bigger lesson is this: not all large cap US equity index funds are the same. The index your passive fund tracks is an investment decision, whether you realize it or not. So when selecting an index fund, investors and fiduciaries should evaluate the index's eligibility rules, weighting methodology, and quality criteria. The answers to these questions can lead to meaningfully different portfolio compositions, risk exposures, and performance outcomes, even among funds that are commonly perceived as interchangeable. Investors should remain attentive to these structural changes in the index landscape. And if you have any questions, don't hesitate to reach out to us and contact your advisor. For a deeper dive into this topic, check out our latest market bulletin, the SpaceX IPO and its implications for index fund investors, which we posted on June 9th, 2026. You can find it on the World Investment Advisor's website under the Insights tab. Till next time.